Okay, guys, thank you so much for coming to our presentation. We're going to talk a little bit about, protecting wealth and investments, particularly during this troubling time. My name is Dave Owens. On the line with me is my partner and really the pretty face of our group, Mark Candler. I'll introduce us in just a moment, or we'll introduce us. You may have heard that the stock market has been a little bit crazy over the last few weeks, and that may have an impact on your investments and retirement plan and the whole bit. So we're going to dive into that. One of the questions that I often get is, okay, where are we going from here? A lot of really smart people have made some compelling arguments that we should be able to resume our bull run from this point. Some other really smart people said, no, we think the market's going to remain kind of in a period of indecision for a while we sort out job claims and things like that. And then yet a third group of really smart people says that we're likely to see a double bottom. This is the calm before the storm, so to speak, and that with jobless claims and small business failures and so on and so forth, that there's going to be this massive trickle effect into the stock market. They all make some really compelling arguments for those. I've read them. I like them all. But we'll kind of get into some predictions and how well that works in just a little bit. Like I said, I will pause for just a moment to introduce our team at Maia Wealth. We'll start with Mark. Mark, are you still on the line?
Yes, I am. Yeah, thank you very much. I apologize, I've got a little background noise. Yeah, thank you very much for being a part of this. And Dave and I would certainly love to help out in any way, shape, or form possible. I've been in the wealth management space for 17 years, and Susan Klopman has been a wonderful client of ours for about the last 12, 13 years. And thank you for your time.
Yes, like I said, I'm Dave Owens. I've been in the industry since '99. I used to trade stock options for a living. I've been in the individual and small business management space for about 9 years now. That correlates very closely with my personal story, which I won't go into a lot of detail here. But Mark tends to be the person who is really good at getting to know people. Everybody loves him. And Mark does a really good job of understanding, kind of the meat of what a person or a small business needs. I'm the geek in the basement who, rarely sees the light of day. Kidding. Chandler is our director of operations. Now, this is not a sales presentation. We mean this to be informative. What I'd like to do actually is start with some fundamentals. You may have heard Vince Lombardi. He was a famous coach of the Green Bay Packers, and a story is told of him after winning the Super Bowl. The very next spring training, he took this group of Super Bowl winning football players and began spring training with, gentlemen, this is a football. I love that story. So I want to take a few moments to kind of just review some fundamentals. I would love for this to be interactive, so if there are any questions along the way, please interrupt me. I'll try to remember to pause at certain points and ask for questions. We'll go through the fundamentals fairly quickly because I want to get to retirement accounts and investments and how current market activities may impact your plans and what you can do about it. Okay, according to financial planning standards, the very first thing that we need to make sure we have in order is our emergency reserve. This is liquid cash that we'll have to ensure that we don't have to rely on short-term debt, which tends to be very expensive. What we recommend as we meet with clients, and we're looking at this on an individual level, on a small business level, that can vary widely. So I'm not going to go into that detail, but a lot of these foundational principles transition or translate very well from individuals to small businesses as well. For individuals, we recommend monthly expenses. So whatever that number is, that would be the minimum balance in your checking account. Of course, we have these ebbs and flows in a personal checking account, whatever your monthly expense is, that nut, that would be the number that we would recommend keeping as a minimum balance in checking. Take that number times 2. That's what we'll recommend for a savings account. So we've got 3 months of cash that's easy to get to. Now, one of the resources that we found on the commercial side is Marcus, this bank by Goldman Sachs. They're offering 1.5% yield on their savings accounts, no minimums, no fees. I use this myself. It's been really easy to transfer money as needed. Aside from credit unions and some other private options you may have out there on the commercial space, this is the best option that I've seen. If you found a better one, certainly let me know. I would love to point our clients that direction instead. But so far, this is the best one I've seen. Now, a mistake that a lot of people will make is keeping too much cash. That used to work. Now, according to JP Morgan's data, if you were to invest $100,000 into a 6-month CD in 1990, you could generate about $8,000 in income, and inflation was only about $5,000. So you're coming out ahead. Not so much anymore. So keeping too much cash may actually be the safest way to lose value of your dollars. And so having that correct balance is something that we recommend. Now, we're showing here 3 months of additional living expenses in a taxable investment account. We want this cash still to be very accessible. We tend to recommend a conservative portfolio, and I won't go into the details of what that portfolio looks like here. But the idea is we want to outpace inflation, or at the very least keep up with it. Now, for those individuals who are not W-2 employees, where income may fluctuate a little bit more, and we may not have the job stability, or at least the income stability of a typical W-2 employee, we might recommend up to 9 months of living expenses. And again, that kind of depends on the individual circumstances. So somewhere between 6 months and a year of liquid cash would be the recommendation. Now from there, as we build this foundation, we want to go into our protection assets. And so we have to ask these ugly questions on the individual side. You know, what happens if there's an early death? What happens if there's an inability to work? Now, for people who tend to be closer to retirement, these types of events tend to be less catastrophic versus somebody who's maybe in their 30s or 40s and still has a lot of accumulation years left. Excuse me. On the business planning side, one of the things that Mark and I will often see is that there are buy-sell agreements in place. They've been drafted and so on and so forth, but there's no funding behind them. Meaning, if somebody were to become disabled, if a partner or a key employee or whomever were to become disabled, there's really no mechanism to support the agreement that's in place. I could tell you from personal experience, and again, I'm not going to go into a lot of my personal story, but I've been widowed twice. I was 29 when my first wife died due to health issues. And I was 35 when my second wife, I lost her to suicide. So the woman you see pictured is actually who I'm married to now. But, you know, I bring this up because we set this plan in motion and we kind of, you know, have this goal. I'm going to make it from point A to point B. We understand that even through personal experience that sometimes there are a lot of twists and turns and bumps in the road. And so creating a plan that allows the flexibility or the adaptability for those situations is obviously an important piece of the puzzle. Now, I want to keep kind of a running list here, if you will, a couple of different lists of threats that we need to be aware of, things that you can talk with your existing advisor about. Of course, Mark and I are happy to have a conversation with you if we can be helpful. But if not, we're going to kind of follow this running list of things that you want to be aware of. So we've discussed premature death and the inability to earn an income due to illness or injury. Okay, next up, we're going to talk about retirement plan. Now, a lot of people think they have the conception that when we talk about investments and retirement planning, that we're discussing the same topic. The truth is we're not. They're very different. Now, although your retirement plan contains investments, retirement planning itself is very, very different from simply investing. Let me explain what I mean. If you're going to climb a mountain, is it your goal to make it to the top, or to make it to the top and then back down again? Obviously, we want to make it to the top and then back down again. And so what we're talking about here is the accumulation phase of our lives, where we're growing our wealth, and then the distribution side, where we're creating income from that. Now, I'm not old enough to have asked this question, but if I had asked my grandfather, you know, Gramps, how much do you have in your retirement account? He would have looked at me like I'm crazy and said, what do you mean retirement account? I get, you know, 80% of my last paycheck for the rest of my life that goes up with inflation. So back in the days of the pension, their focus was not accumulation, it was distribution. Now, when pensions went away, and there are a lot of reasons for that, and we moved into our defined contribution plans, we began focusing more on accumulation. What's my number? You may have heard that old commercial. I think it was Fidelity. What's your number? You know, what's the number that you have to retire? Well, it's not a terrible question to ask, but it might not be the best question to ask, or at least it might not be the last question to ask. If you're 65 today, the odds of making it to 90, you can see this graph right here. If you're a married couple, it's a coin toss that at least one of you makes it to 90. So one of the challenges we're going to have in retirement planning is this longevity risk. And in the 401k world, we really don't have any means of guaranteed income. So the risk of running out of money, especially when you might need it most, can be pretty high. So make sure that when we're doing our planning, whatever that is, we need to take into account longevity risk as well as inflation risk. If we need $100,000 of income today, then speaking on an average perspective, about 25 years from now, we're going to need $200,000 just to maintain that same buying power. Okay, let's look at a real quick case, and I want to just talk through some ideas with you, some risks and what they look like. This is a system that Mark and I use in working with our clients, and if this is something that you want access to, we're certainly happy to give it to you. You don't have to become a client of ours, but you're certainly welcome to have access if you'd like. What we're looking at with this client is we've got all of their assumptions in. What will living expenses be? You know, what assets do we have? That type of thing. And you can see this little bump right here. This is an inheritance that Steve is expecting to receive at some point. And one of the threats, or one of the risks, I guess, a caution, maybe would be a better way to say it, is we look at this and we think, you know what, that's okay. We're going to be all right. But the problem with a model like this, if we use it exclusively, is we're assuming a constant rate of return in all of our investment accounts, which obviously is not going to be accurate. One of the things you want to make sure that you review with your planner is Monte Carlo analysis, or probability. That says, well, okay, that's what it looks like it's going to do. Now, what's the likelihood that that actually happens? And so make sure this probability analysis is part of the planning that you do. Now, we could look at a couple of different things and say, well, you know, what if I retire later? And I'll kind of go through these fast. You know, what does my plan look like if I retire later? What happens if I reduce my living expenses? If I downsize my primary residence by 1/3? And that actually tends not to help people quite as much as they think it will. You know, what if I sell the vacation home? That type of thing. Now, one of the recommendations that Mark and I sometimes will make to our client, talk to your advisor about this, are some various advanced planning techniques that we might use. Now, I used that mountain analogy regarding retirement a little bit earlier because you can see that what we're doing in implementing some of these advanced techniques before retirement is we're actually decreasing total net worth. The reason for that is because we want to be able to increase income streams once we get into retirement. And along with increasing those income streams, we want to be able to increase the probability of success. And those scenarios that you looked at, they're all cash flow neutral. We didn't spend any more or less money to achieve that. So definitely have a plan, an income plan, not just an accumulation plan with the planner that you're working with. That plan needs to include what happens if there's a bear market at retirement. Now imagine, and maybe you know some people who on January 1st of this year said, that's it, I'm going to hang it up. I'm done, I'm ready to ride off into the sunset or whatever it is. And, you know, by March 15th or so, April 1st, somewhere around there, they might have really started to rethink that retirement plan. The truth is, a significant market downturn within the first 5 years of retirement is absolutely catastrophic to the ability for that retirement plan to be successful if it's based primarily on market-based assets. And the reason for that is because of the disproportionate number of shares that you have to distribute in order to achieve income. Here's what I mean. Let's say, for example, that you need to liquidate 100 shares in order to generate your retirement income. And then the market dives by 30%. Your 100 shares just turned into 143. Well, now we have 43 shares less, 43 shares fewer to participate in an eventual market recovery. And so while your average rate of return might look appropriate over a given period of time, when you're talking about varying numbers of shares that are participating in those losses or returns, you can paint quite a different picture. So this is the advanced techniques. Again, make sure that advanced technique with a bear market, you're ready for that and you've planned for that. They tend to happen, well, historically about every 5 years. Now we have been on nearly an 11-year bull market run from 2008 until the coronavirus, or maybe we were right at 11 years. But historically, those happen about every 5 years. So here we go, an efficient retirement income plan. You're going to make sure you've covered longevity risk, inflation risk, and poor markets in retirement. One of the other things that you definitely need to have a conversation with your advisor about is the low interest rates. These are, I don't want to say catastrophic, that might be a strong word, but these are going to stress your retirement plan in some way. These interest rates are really going to drive a lot of the debt instruments that you'll use as part of your retirement plan, like bonds, your cash alternatives, CDs, things like that. If you wind up using some of those, commercial paper, some of those other things that rely on interest rates or cash value in a whole life insurance policy, they may be impacted by this. And, you know, we saw these rates back here during the financial crisis. The Fed dropped them to 0 with the goal of stimulating the economy, and it looked like we were tracking back up. But now with coronavirus, we're sitting on the floor again. That was not expected and is not necessarily healthy. If we look at LIBOR, and these are kind of some probability measurements of the curves, we see that, you know, we're out 8 years probably before LIBOR is above 1%. And so we may not see that stress on those interest sensitive investments right away, but we may see a bit of a lag. So again, make sure that your plan accommodates for the lower interest rate environment that we're in and will probably be in for the next several years. Long-term care. I think a lot of people don't realize what type of an impact a potential long-term care need has in retirement, it can quite frankly be a hand grenade. And so I won't go into a lot of details on what types of solutions you might consider, but the truth is you can look at a standalone product. There are some hybrid products out there that marry with other investments really well. Make sure that you have your eye on that. Okay, investments. Here's the fun part. One of the first things that I always suggest people evaluate, and when Mark and I perform analysis on people's existing investments, one of the first things that we want to talk to them about is fees. Now, most people really have no idea how fees and investment accounts work. You might call your advisor up and ask, what's my fee? And he or she says, well, you pay 1%. Well, that's a true statement. Your advisor didn't lie to you, but they may not have disclosed everything, and you didn't know to ask that there are all these other fees stacked on top of it. Additionally, depending on how you're invested, you likely have a fund expense ratio. Now, this fund expense ratio right here, that's kind of tricky because that really doesn't show up anywhere on your quarterly or monthly statements. It's there, and really the only way to find it is first to know that it's there. You probably had some disclosure documents initially that you didn't read. Well, you guys are attorneys, maybe you did. But from a monthly statement perspective, the only way that you'll see this fund expense ratio is if you go through and calculate all the gains and losses day by day, and you figure out, hey, I'm missing some money. Well, that's where it went. So when you talk to your advisor, be sure that you really drill deep on this and ask them about the all-in costs. On average, when Mark and I evaluate existing portfolios, we'll see all-in cost anywhere between 1.7, 1.8% on the low end. I've seen them as high as 3.1, 2.3 right here is about the median, somewhere in that neighborhood. The impact of fees over time is quite significant. So let's go back to Steve and Beth's base case, and if we could reduce the fees in their accounts, make no other changes, just reduce by 0.5% or 50 basis points, that's the type of an impact over the course of their lifetimes that we would look to have. That's a significant improvement. Okay, so talk to your advisor about all fees and charges and really drill deep on that. All right, let's get back to the coronavirus. Where is the market going? I don't know. And quite frankly, I think that anybody who suggests otherwise, they're either lying or lucky. Yeah, somebody is, one of these three groups is going to be right. I'm just not sure which one it is. Over time, the market goes up. Now, this principle is less applicable to someone who's closer to retirement because you may, depending on how far away you are, you may or may not have time to participate in a recovery. We do know that trying to time the market tends not to work. This was a study done by JP Morgan over a 20-year period. And what they found was that 6 of the best 10 days occurred within 2 weeks of the 10 worst days in the market. And so someone who tried to get out and wait for an opportunity to get back in, if they missed those days, wound up reducing the return from 6 to a little more than 2. I'm going to go through this kind of fast, breaking even, and you've likely seen something like this before. The math is different. So if I have $1 and I've lost 50%, then I need 100% return just to get back to even. And so when we see these declines within the market, we tend to need between 3 and 6 years to recover our losses or to get back to zero. And it's because of this principle. We kind of saw this before. If I've lost 30%, then I need to gain 43% just to get back to zero. And that was the liquidation math that I gave you earlier with 100 shares and 143 shares. I want to get into the bucket strategy, which I think is really applicable for people who are near retirement. And by near, I mean within 5 years. Before I do, I've forgotten to pause and ask if there are any questions on what we've covered so far. Okay. So one of the things that a lot of people will do is they'll say, well, I've got this portfolio and it's, 70-30, 70% stock, 30% bonds. And then as I get closer to retirement, then I'm going to shift that to, 60% stock, 40% bonds, and then maybe I'm going to go to a 50-50. That can be pretty tricky in retirement because you've got a lot of moving parts now. You have stocks, the value of the stock side of your portfolio that's fluctuating with the market. Bonds fluctuate too. They tend not to be as much, but they do fluctuate. And then you're also pulling money out of those things. And so it is really difficult in retirement to not become imbalanced. And when we need to measure the ability to grow our assets with the ability to achieve income, and we don't want to liquidate our stocks when they're low. We've kind of already talked about that piece. That can be really tricky. Now, one of the reasons that a lot of people do this is because A, they don't really know that there's another option, and B, because it's easy. With Mark and I, with our clients who are close to retirement or in retirement, we employ what we call a bucket strategy. And I don't remember if I heard somebody else say that or if we just made it up, but we call it the bucket strategy. And here's how this works. We're going to take our near term and we'll put 1 year of income requirement in this bucket. Now, this is going to be a conservative portfolio. And we're going to kind of look at some details of that later. This is money that we'll use when the markets are weak. Right now would be a great example of that. And then we'll have a midterm capital needs. Now, it says the next few years. This is kind of a moving target depending on the person. It might be an additional 2 years. It might be more. Kind of depending on risk tolerance, what other assets we have in place, what stage of retirement we're in, meaning how far into retirement or how far away from retirement. And the goal behind this is we want to take a little more risk, but we also want to try to outperform inflation just a little bit more than what this near-term capital needs bucket's going to use. And we're going to dip into this one when the markets are weak or when they're in recovery, and we've exhausted our first bucket. And then we're going to have a long-term capital needs. This will be a more aggressive portfolio. We'll keep in here income that's not going to be needed for several years. And we'll use this bucket when markets are strong. Now, super, super important. We want to evaluate and rebalance these buckets at least annually. With some of our clients, we'll meet as often as quarterly. Most people are annually. Mark and I are fine with either or semi-annually or whatever. Now, let's look at this portfolio in action as a whole. And that's the green line here. What we're looking at here is the bull market, 2013 to 2013. And you can see that the S&P went up 29%. Now, you look at this proposed portfolio that we have. First off, you see there's less risk, 65 versus 78. And you say, well, my gosh, we had less risk and we outperformed the S&P. That looks great. That's great, but that's not really the story. Let's look at our short-term bucket. Our short-term bucket did terribly. The S&P did 29%. Our short-term bucket gave us 1.2. And so this would be an opportunity for us to look at the long-term bucket that is really responsible for the outperformance of this fund. 52%, that's the bucket we're taking our income from. Now, let's look at the financial crisis. You may remember that, 2008. We'd see that the S&P lost 53%. Our portfolio lost 23%. Now, That's great that it didn't lose as much as the S&P did, but still 23% losses are pretty tough for a retirement account. And we'll see that our aggressive portfolio actually lost 25 and a half. But our near-term bucket that was built for this actually returned over that same period 3.8%. So this is where we go get our money. It's a very involved strategy that allows us to be more prepared for these bear markets and respond accordingly. And bull markets, I should say that. They allow us to respond to our bull markets as well. If you're curious, over the last year, this entire portfolio is up 5.6%. And I should say that these graphs do not include distributions. This system that we're looking at here doesn't account for distributions. But over this time period, and again, this is the conservative portion of our portfolio, over the last year is up 11.2%. So this is, again, this is where we're getting our income in this particular case. So talk to your advisor about not just those portfolio rebalances, but a liquidation strategy. You can follow the method of, I'm going to move from a 70-30 to a 60-40 to a 50-50. That's not the wrong answer necessarily, but I think with a little forethought and a little more active decision making, you can probably do better. So liquidation strategy. I want to talk about tax loss harvesting next. That might be an opportunity that you can capitalize on right now. Before I do we have any questions or comments on the bucket strategy? Okay. Tax loss harvesting. This is a strategy that will work in your non-qualified accounts. So leave the IRAs, leave the 401ks aside. This is not applicable to those accounts, but if you have a taxable account, a lot of people will call them a brokerage account. There's a great opportunity here. Let's look at just the oil and gas sector of our asset allocation. And I just made this up for illustrative purposes. It turns out that having a global pandemic followed by an oil war may have a negative impact on the oil and gas sector of your portfolio. Now, our natural human, let me try that again. Our natural human inclination would be to say, well, technology is doing great. Let's buy some more of that and let's dump this oil and gas stuff. That really isn't the right answer. Oil and gas is low. It's going to recover at some point. What we might consider doing is evaluating our holdings. And let's say, and I made this super simple, and let's say our oil and gas was made up of ExxonMobil. What I'm going to do is sell ExxonMobil for a loss. Now, the IRS says that in order for us to claim that loss, we cannot repurchase that same stock within 30 days. It's called the 30-day wash rule. And if we do, then the loss is disallowed. Now, we know we want some oil and gas. We want this oil and gas sector because we want to be part of an eventual recovery. But we want this wash rule. So we're going to sell ExxonMobil. We're going to buy Chevron. And we're going to say, you know what, pretty much one big oil gas company is going to perform like the other one does. And then after our 30 days are up, we can keep Chevron, or we could sell it and buy ExxonMobil back. Now, the benefit of this is we can use that realized loss to offset realized gains that we have. And right here, I'm showing that our realized gains are higher than our realized losses. That may or may not be true, but we can use those losses to offset gains. Now, we can claim $3,000 in in losses in excess of gains. And if there's a balance, we can carry that forward for a number of years as well. I won't get into the details of that here. But without this strategy, we really we're not claiming any realized losses. So talk to your advisor, your broker, whoever you have about a tax loss harvesting strategy. Okay. Gifting, we're gonna kind of wrap up fairly quickly on the gifting. I should stop and ask questions on the tax loss harvesting before I hand this over to Mark. Okay, Mark, are you still on? Do you want to talk about gifting?
Sure. Yeah, thank you, Dave.
Mm-hmm.
Dave and I have a true passion for combining philanthropic planning and financial planning, and are both very active in the nonprofit community. Dave's very involved with the Second Wind Fund, which helps teenagers cope with suicidal thoughts and deal with suicide. And I'm very involved with Craig Hospital and several other nonprofits as well. And something I just wanted to point out is that for law firms and for individual attorneys, solo attorneys, there's a great way to gift for your kids to go to college and receive a significant 20% tax credit in doing so. Certainly, we would love to help out anybody with, running strategic college funding plans, whether it's University of Colorado at Boulder or Metro or ACC or Princeton. We can, certainly help guide, what are the tax benefits and what are the potential losses and how much to put in a college fund. Certainly something else, justserve.org is a phenomenal way for people who, care about the community to get immediately involved in response to COVID-19. Something else that we work with our clients with, and certainly in conjunction with estate planning attorneys, is, mitigation of estate taxes, although that threshold is pretty high right now, of in excess of $11 million per individual. But that is certainly an area where we love to help people out. Yeah, with that, I just wanted to say that we would love to help anybody on this call or anybody that you discuss finances with to receive a free invitation to log on to the digital portal, which is what Dave has just walked you through. And literally all you would need to do would be just to shoot me an email, and that it makes no commitment in any way, shape, or form to ever become a client or ever even speak to us. So that is just a resource that literally we can have about 1,500 simultaneous users. So great way to simplify, consolidate, and truly spring clean your financial world. And certainly would be honored to schedule a 15-minute phone call as well. But with that, I just really wanted to open it up to questions. Any questions we can field or help out with right now? Okay.
I wish I was close to retirement, but I'm not. So I don't have any questions, but I think this was super helpful.
Thank you, Miranda.
Yeah, absolutely. So I'll make sure that everybody has all of your information for follow-up. And just in case kind of a public forum isn't the right place to ask these questions.
Sure.
But I want to thank you both for doing these back-to-back presentations for LawBank, and I will be sure to post the recordings of your YouTube, of your webinars on the YouTube channel, also on the LawBank website for people that couldn't attend.
Great. Miranda, thank you so much for setting this up. Everybody, I hope this has been informative and beneficial for you.